My first post this week was about the US rig count, and I showed a map of the change in US rig count by county from the first quarter of 2024 to the first quarter of 2025. What I showed was that the US had dropped 35 rigs, about 6% of the total rig count year over year. And sure enough, the largest rig exodus came from the state of Texas, which is not shocking given that Texas is responsible for about half of the drilling rigs that operate in the US. But there were several states that showed rig count additions year over year. Wyoming was at the top of the list. Oklahoma was in second place. And so when you look at this map of the change in rig count year over year, I showed some green areas are the counties that added rigs. Some red is where the counties that have dropped rigs, and the yellows are where the counties have remained mostly flat. I did that for a bunch of different reasons, but one is we pay a lot of attention to the headline numbers around rig counts, and those matter, right? It makes total sense why we pay as much attention to those numbers as we do. And yet, when we look at some of the county level detail, we get a sense that it's not just as simple as rigs entering a market or leaving a market. There is a lot of geographical shift going on in terms of rigs concentrating in particular areas, even as the total rig count starts to come down. So that map gives us some more color so we can realize that this capital deployment exercise that takes place across the US oil field is an ongoing exercise. And even if rig counts are growing, if they're declining, there's still important shifts that are happening beneath those headline numbers. This was one opportunity for us to look at the data beyond the headlines. My next post this week was about the set of notes I sent out for our Energy Book Club. We now are on the second book for our Energy Book Club, which is The War Below by Ernest Scheider, all about critical minerals. And like I did for our first book, I created a series of notes. It was about a 6-page set of notes that I sent out to everyone that signed up to participate in the book club. And these notes have excerpts from the book and questions that I am asking myself that I'm going to pose to the group based on what I'm finding interesting in the book. It's just a way for us to guide ourselves through the conversation. So if you're reading the book, or if you're just interested in all things critical minerals, or if you're interested in what I'm particularly finding notable in the book, then you can download that set of notes. It was a LinkedIn post that I share freely because it's just a nice way to add a little bit of structure to our book club conversations from time to time. My next post was also about critical minerals. What I did was highlighted the stock price move in Southern Copper. It's a US domiciled entity, copper entity, that is predominantly owned by a Mexican conglomerate. But there are some shares that trade on New York Stock Exchange, the Lima Stock Exchange. So we do get some exposure to the company's operating and financial performance. What we've seen is the stock price for that mining company is way down. They, in their annual report, said that they believe they have the largest copper reserves in the world. So it's consequential when it comes to the copper story, what's happening with Southern Copper specifically. We saw its stock price dive on Thursday. It's diving again on Friday, largely as a result of tariffs. What I highlighted, though, was that the management team, in their call back in February, when they were discussing the full year 2024 results, were asked about tariffs. And they talked about their ability to have U.S. importers absorb some of those tariffs and to be able to redirect some of the copper and other products that they create to other markets. And it's just a good demonstration of one management team's thought process as it comes to navigating tariffs and what we might see in the US, right? Which is prices go up as some importers are going to bear the brunt of these tariffs. And then some of these goods that otherwise would have made their way to the US will get redirected into other markets. So the tariff story is obviously very much, uncertain. There's a lot of moving parts to this that we just won't know until, some of the details get ironed out and we just see some inertia behind what eventually will result. But it is helpful to acknowledge what these executive teams are thinking through and how they're positioning their companies to respond to the tariffs. My last post for this week was about oilfield service stock price moves. What I did was showed the stock prices for the big four, SLB, Baker Hughes, Halliburton, Weatherford, how those have evolved since 2021. I specifically normalized the stock price to each company's average in 2022. So we kind of shrink these down, get them all on the same page. We get a little bit more of an apples to apples type comparison. And what we see is there's basically two groups. The lower performing group is Halliburton and SLB. Halliburton's stock price today is actually down about 25% relative to what it was in 2022. Clearly bad news. It's even worse given that the market on the whole has risen over the past 3 years. So Halliburton is by far the most challenged of these four when it comes to its stock price. SLB is about flat. It's trading today right about the range of its 2022 average. Again, not a great outcome when the whole market is growing and has grown over these past 3 years. So you see, Baker Hughes and Weatherford have both exceeded the growth in the broader market, but they are on very different trajectories. Weatherford had this massive boom into July of 2024, after which it's been crashing back down to earth. Whereas, again, right around July 2024, Baker Hughes starts to make this uptick and it is climbing like it is today. So this chart shows this clear divergence in paths between these two segments of oilfield service companies. And then even within this better performing segment of Baker Hughes and Weatherford, it shows a clear divergence between those two companies specifically. In my post, I explained what was so important about July of 2024 and why we've seen this divergence between Weatherford and Baker Hughes specifically in that period of time. Each weekend, I send out a free weekly newsletter that includes links to and summaries of all the research that I post online during the week. That way, you don't have to rely on social media algorithms to surface any of that for you. I also include an energy related anecdote, insight, or observation that I don't share anywhere else. So even if you've seen everything that I've published online, you'll still have something new to read in the newsletter. If you haven't signed up to receive that, you can hit the link under my name above. I'll also put a link down in the comment below. I also have a newsletter called Foundations of Energy that I host on Substack that's aimed at helping energy professionals build their strategy and finance acumen. I specifically take a pretty deep look at why our energy systems look the way they do today and why they're evolving the way they are going forward. If you haven't checked that one out, I definitely recommend you do. My next post there will be a characterization of the oilfield service space as we get toward Q1 earnings seasons. Clearly, the stock price post that I talked about will figure prominently there, but I'll go through some of the financial results that we have across that sector and analyze those, put those up on Foundations of Energy. So if you haven't checked it out, I'll put a link to that one down below as well. As always, thank you so much for reading, watching, liking, and commenting. I really appreciate it. I hope you had a fantastic week, and we will talk soon.